Well, hey, welcome back. This is our third quarter update here at Abundance, and joined again with me is Casey Hazen, Senior Portfolio Strategist with Horizon Investments. Casey, how's your fourth quarter going so far?
So far, so good. I can't believe that 2024 is already coming to an end, but it's been a great year. How about you?
Yeah, oddly enough, it's been a great year for us as well, and so a lot of great things are happening. There seems like the world's in turmoil, but it kind of keeps spinning around every time I check. The sun comes up and it goes back down. So until that stops, I think we're going to make it through just fine.
I think so.
Yep. So what kind of things you want to get into today around the third quarter? I know there's a good bit that's happened as usual, but specifically, I know there's some topics we wanted to get into. Is there anywhere you wanted to get started today?
Yeah, I think just getting started with a high level view of the economy and kind of some of the things that we're looking at. This quarter, we're really focusing on this idea of just normalization. In the past, we had talked about how really with COVID, essentially, it took us off this idea of a normal market or a normal economic cycle where you have a pretty consistent expansion phase and then contraction phase and then trough and peaks. That was completely thrown off by COVID. So what we've seen more recently is just the economy starting to normalize. And I think one way to really illustrate that normalization is to look at, the overall consumer economy. So this looks at retail sales, and you can see again we had this extreme swing to both the downside and the upside around COVID. And then over the past couple of months, past couple of quarters, we do seem to be settling back into this very healthy level that is consistent to where we were, pre-COVID, which that 2017 and 2019 period, if you'll remember, was a very, very strong economic environment. So for us to settle back into this area is quite optimistic from everything that we're looking at.
Yeah, that's good. I know what's so interesting to me is how often I get the headlines from a client or a concerned friend, and so often if you dig below the surface and take a greater look at things, you start to find that things are on track, right? We may see some consumer debt hitting an all-time high. Hopefully we'll get into this, but in the context of everything else, that consumer debt may be all-time highs, but the net worth, the earnings ability, or the actual wages of all those people being taken into consideration is actually remarkably better. And so it kind of softens or tampons the clickbait that some of these headlines tend to be. So I'm
Yeah.
glad to hear that retail sales are also coming back into what we would have expected, especially on the heels of what 2019 was. So that's great.
Exactly. And, to your point around, the labor market, because I think there's been a lot of concerns or there's been a lot of headlines with weakening in this current labor market. And if you look again, or if you kind of zoom in too far and you look at trends, yes, things like unemployment are rising. We went from a very, very low rate of kind of low 3% to somewhere around 4%. If you look at hiring rates, those are slowing down, and so the direction of some of these is not going in a positive direction. Wage growth has come down pretty substantially as well over the past handful of quarters. On the surface, that is maybe alarming, but again, you got to zoom out. And if you zoom out and if you take COVID out of that COVID environment out of the picture, you'll see we're right back on trend, which again, pre-COVID was a very, very healthy labor market. And
Yes.
so what we're doing is kind of getting rid of some of the excess, especially in the labor market. Specifically with wages, lower wage growth doesn't sound great on the surface. But one thing that was driving a lot of the inflation was services, was kind of the wage pressure that companies were experiencing. And so for that to be coming down, that's also helping out this inflationary environment and this inflation trend, helping it to move in the right direction. So a lot of the recent inflation reports that we've seen are coming in quite strong. This last CPI print was something about 2.6% on the headline. So
Yeah.
still a little bit elevated from the Fed's target of 2%, but you can see pretty clearly we're moving in the right direction. And maybe more importantly than how we feel, that the Fed is also feeling much more comfortable with how inflation is going because they obviously just cut interest rates this past month in September. And they've forecasted very clearly that they're going to continue to cut interest rates. And so that is obviously very, very important because we know that interest rate cuts are very stimulative to the economy. And so the plan for the Fed through the end of 2025, as of now, is roughly 6 or 7 additional rate cuts of 25 basis points. So that's a very, very large tailwind, I would say, to the economy, which, as we've already discussed, is in a pretty healthy place. So again, the everything that we're seeing, economy maybe softening, but not weak at all, with this additional tailwind that the Fed is going to continue to support any sort of potential weakness in the economy is a very good backdrop for where we currently sit.
That's good. Well, I remember back in 2022 when we were seeing those high single digit, low double digit inflation prints. It was believed that the Fed would never get us back down to where we are. People were banging the desk about that. This is never going to happen. And sure enough, they actually did it, you know? So kudos to them. All right. So so it seems like normalization across a lot of different facets of the economy is the name of the game in this season, right? So you've got the economy normalizing, labor normalizing. So what about the consumer?
Yeah, on the consumer side, they're in a very strong place. You know, we talked about retail sales. That's obviously primarily driven by consumers. But we look at the consumer balance sheet, and it continues to be very, very healthy. You know, one aspect that I think gets a lot of attention is just the level of debt in the U.S., whether it's on the consumer side or whether it's on, the government side.
Yeah.
The absolute level of debt in the country is rising, and it's rising at somewhat of an alarming rate. But I think not to minimize that, because I think it will eventually be a bit of a problem. But the optimist view is that if you look at household wealth, it's also been rising, and it's been rising at a much faster rate. So that's something that's obviously very, very positive that we're seeing. And if household wealth continues to outpace, the increases in debt, that's a very, very good backdrop and makes the debt that much less of a now issue. And again, looking at consumer balance sheets, I think one way to look at it is just how much cash is sitting on the sidelines. And so this chart here is shown in the amount of wealth sitting in savings accounts, checking accounts, money markets accounts, and in trillions of dollars. So you can see we're at very, very high levels right now. Obviously, around 2020, you can see there was a pretty precipitous increase there. But what we've noticed is that it's been leveling off over the past couple of years. It hasn't been decreasing, which I think is the most important thing, because that was the big concern. Is we had this liquidity injection, people spend down all that additional money, and you go back down to what the trend line was. But if you were to draw a trend line, from the 2010 to 2020 period and continue it on, we're still about $4 trillion above where we would have been, outside of that COVID era. So still very, very healthy from a consumer balance sheet standpoint. And that's obviously important because that's going to continue to spur further consumer spending, which, as we've just seen in recent economic data that's been released, continues to come out above expectations and continues to be very, very strong.
Yeah, it's interesting how you hear some people complaining and other people are actually, maybe they're cautious because they're worried about whatever the factors are, but largely amongst the affluent, it's steady as she goes, right? They're doing well, their businesses are moving forward, or their real estate assets or whatever they may be is moving forward fantastically well. And so it's just interesting how when you pull the noise out, things actually look pretty decent.
Mm-hmm.
One of the things that I wonder, is this the space we can get into at Casey? I've got some clients who have asked about speculating and then this is not a recommendation, but this is just, I want you to speak to something that is one of those old rules of thumb about as interest rates go down, the value of bonds go up. And I've got clients saying, hey, maybe we should buy some longer term bond portfolios because if interest rates are about to drop this much, then man, we could get um, some capital appreciation on our bonds along with, some decent yield while we're waiting. So is there a place where you can just talk to how, and this may be off script, but um,
No, yeah, I
is
can.
there a place where you can kind of communicate to that? That'd be great.
Yeah, absolutely. So our view for the outlook for broad fixed income is not negative, but it's not overly optimistic. You got to think about where we currently sit within the fixed income environment, within the yield environment. There's this idea of a yield curve where traditionally it's positively sloped, meaning that shorter term fixed income or shorter term debt has a lower yield and you get paid some sort of premium for holding on to longer term debt, taking on that additional time risk. But for the past 3 or 4 years, it's been inverted, basically meaning that the short end, the front end of the yield curve, the shorter term debt is actually paying out more than longer term debt. And that was all spurred with the Fed increasing interest rates as much as they did. It moved the front end much higher, and the long end of the yield curve remained a little bit more depressed. So, with the Fed cutting interest rates or expecting to cut interest rates over the next couple of quarters, couple of years, what our expectations is that the front end of the yield curve moves down from, call it 5% right now, down to 3%. And if you think about a normally sloped yield curve, traditionally there's about 1 percentage point between the short end, or call it like what the Fed is currently pricing out, and the 10-year. And so if the Fed cuts interest rates to 3%, you add on 1% on top of that, that's where the 10-year roughly, again, very, very roughly, is should be. And that, again, 4% for the 10-year, that's pretty much where it is right now. And so that's just showing you that, the belly of the curve, the long end of the yield curve is probably not going to move substantially lower, even with the Fed cutting interest rates by 2+%. It's already fairly valued because the longer end of the yield curve is based on, market expectations around economic growth. And those have already been priced in pretty well. So expectations for fixed income performance going forward is, I think what the current yield is. So call it 4.5% plus maybe 1.5% for some credit risk that you're taking on. So 5 to 6%, I think, is a very fair expectation for like an annual return from fixed income for the next couple of years.
So, so basically, and I know my little hand gestures may have been backwards. I'm still not accustomed to using the camera. So basically, if they lower interest rates, it's only going to affect short-term debt. It's not going to impact the long-term debt. And so, for those of you watching, Casey and I meet on a quarterly basis to review all of the models and have a deep dive. It's an investment committee meeting that we have, and so with that, we did a deeper dive on this. And what we found is that for you to speculate and buy longer term bond funds or buy longer maturity debt, the only way for you to really see a level of capital appreciation that you may have seen in the 2022 range would be for something more catastrophic to happen, more of a negative event. And I'm just saying that's not that's not the motivation behind buying it. It would be if you're trying to buy it because interest rates are coming down, it won't make you the money that it had. The only way it would make you that level of money from maybe a couple of years ago would be something more negative. And so I would just say that speculating in buying longer duration bonds, if you're really worried about what might happen or might not, um, that might not be the way to play it anyway. So as usual, we need to talk about all of your goals individually and specific asset mixes to be sure that they're suitable for you. But just wanted to kind of break that paradigm, because unless you have a conversation like what we're having here, you would just think interest rates are coming down, buy longer term bonds, and you just take possibly unnecessary risk with a portion of your portfolio. And so from what we've seen, if you're trying to play it, and this is not to speak to a strategy that you need to employ individually, your chance to raise your capital or have capital appreciation may not come from the fact that interest rates are coming down. It could be that the stock market or other assets benefit more directly from the Federal Reserve lowering interest rates like that. So this is just in an effort to demystify. Again, this is not a recommendation. We're not saying that you need to make specific changes from what you hear today. You need to speak with us before you have any type of amendment to your investment path.
Mm-hmm.
So thanks for engaging that, Casey. I know that was something we wanted to talk about, but we hadn't quite figured out where it was going to fit, and we made it fit, didn't we?
Yep.
So the last thing that I had was just commentary on the stock market, because I have heard clients say again and again, it's overvalued. And I know last quarter we went in and said that actually there's places where the market is fairly valued based on the earnings backdrop and the comparison to, I guess it would have been the tech bubble and its pricing and how speculative or how overgrown the market was at that time, that this is not that kind of market. So
Yes.
Casey, do you have anything you want to share to speak to that by chance?
Yeah. So you think about what's been driving markets, call it over the past couple of years, especially equity markets, and it's been mega cap technology. So it's been the Magnificent Seven we've talked about. We've talked about AI darlings, and they have seen pretty significant share price appreciation over the past couple of years. And we've even talked about the similarities of today's equity market environment and the 1990s, with this idea of a new innovative technology emerging. Obviously back in the 90s, it was the internet, and today it's more of this AI technology that's coming forth. And so there have been comparisons, and there's similarities in the appreciation that you've seen in some of these companies. We obviously know what happened at the end of the 90s with the tech bubble popping. And so there's concerns that that's the direction that we're heading in this go around. But I think the main thing that's different is just the underlying fundamentals of the companies today look far different than the underlying fundamentals of the 1990s. Today's companies are far more profitable. They have far more cash on hand than what we saw back in the 90s. And so a very kind of easy comparison to make is NVIDIA, which is the definition of the AI kind of darling that we've seen. And you can see since 2022, in the blue line here, share price has absolutely gone exponential. But what has also increased in line is their earnings per share. So from a valuation standpoint, which is price over earnings, they're still about as attractive as they were back in 2022 before they had this significant share price increase. Very different than some of the companies back in the 90s. Cisco was the kind of internet darling back then. And between 1998 and 2000, you can see exponential growth in the share price. But what did not keep up nearly to the same extent was the underlying earnings. So that's really where you saw valuations completely blow out. That hasn't happened to the same extent this go around. Not to say that companies like NVIDIA or Apple or Amazon are cheap per se, but they're just not as expensive as they were, or as, the tech companies were back in the 90s. So that level of concern is not nearly as magnified as it was back then.
That's fantastic. And also it really deflates a lot of those headlines that we seem to try and use, I guess, some form of fear mongering, right? So here we are demystifying it again. So yeah, so I think generally what we're seeing is that it's kind of working out. While there's been some doom and gloom or potential negative overhang, a lot of that's been abated. And so just as a general plea to those of you who are clients, not making the recommendation without talking to you individually, but there's been a place where some of us, or I've kind of allowed us to move into a more bearish position in the last 12 to 18 months because you were concerned about different things. And so I'm saying that this would be a good time for us to reevaluate the level of risk that we are taking, because if what we see now does play out, then there's a potential where we could miss out on some of that growth. So definitely don't take what you're seeing here as a means of saying you need to make the change, because individually you need to decide that. At the same time, also, please don't try and make these changes on your own in other places. I would rather give you the counsel and make sure things are part and parcel to your overall goals. but it could be a time where if you're not quite ready for a review, but you want to talk to us about that, please use this video and reach out to us, connect@findabundance.com, or you can call or text our office, 678-884-8841, to be able to have a review. And it could be that by the time we get up for the normal review that we should have taken some action, and those 30, 60, 90 days could make a difference contingent on what happens in that time frame. So don't want you guys to miss out on growth, because I know that we're in this for expansion of your wealth or protection, depending on as the case may be, but I don't want to miss out. So reach out to us. And so with that, Casey, any final comments, anything you wanted to touch on before we part company today?
Well, I think we covered a good majority of what we've been talking about with a lot of other clients. Things seem to be strong from an economic standpoint. And then to your point, I think another big tailwind that we haven't had over the past couple of quarters, the past couple of years, is a more supportive Federal Reserve. So both of those combined give us much more optimism leading into the remainder of 2024, but even into 2025. So I would say overall, we're quite optimistic with what the near-term future has to hold.
Yeah, same. So from what I've seen, I would agree. There's also, like you said earlier, a lot of cash on the sidelines. So just what happens when that money starts rolling in, and people would be blown away if the market just melted up again and shot up another 20, 30%, unprecedented, right? So not saying that it would, of course, but still we're getting some of those precursors to where things like that occur. And then you really wonder, oh my gosh, now have I missed out? And so just want to be sure we're in the right model with you, and we've considered all of our options. So Casey, thank you so much for the time that you spend, and also a thank you to your team and staff at Horizon for all that they do to support these models, and really encouraged from what I've seen in a lot of levels. I can't speak to performance because it's we can't get specific, but been very delighted and happy with the work that you guys do. So thank you so much for that. We look forward to seeing you, I guess, after the new year.
After the new year, yeah. Enjoy the rest of it.
All right. Yeah, enjoy the rest of your fourth quarter, Casey. Thanks so much. We'll talk to you again.